In 2008, the world panicked. Banks in Europe were on the brink. Asian exporters couldn't roll over short-term loans. Global trade was freezing in real time. And in the middle of that chaos, the most powerful financial institution on earth didn't just rescue American banks. It rescued foreign central banks. The U.S. Federal Reserve opened emergency dollar swap lines to Europe, Japan, South Korea, Brazil. Stop and think about that. Why does the Central Bank of the United States have to supply dollars to the rest of the world? Why does a crisis in Hungary or Argentina often begin with a shortage of U.S. dollars? Why is oil priced in dollars, global shipping settled in dollars, and international debt written in dollars? And more importantly, why decades after the gold standard ended, does the U.S. dollar still dominate the world economy? This isn't about patriotism. It's not even mainly about military power. It's about systems, it's about plumbing, and it's about a quiet network effect that became so large, so embedded, that replacing it now would feel like replacing the electrical grid while the lights are still on. To understand this, we need to go back. After World War II, the United States wasn't just another economy. It was the economy. Europe was devastated. Japan was rebuilding. The U.S. produced roughly half of global industrial output. It held most of the world's gold. In 1944, representatives from 44 countries met in Bretton Woods, New Hampshire. They needed a new financial order, something stable, something predictable. They agreed on a simple structure. The U.S. dollar would be tied to gold at $35 per ounce. Other currencies would be tied to the dollar. The dollar became the anchor of the global system. If you trusted gold, you trusted the dollar. If you trusted the dollar, you trusted the system. And for a while, it worked beautifully. Trade expanded, economies grew, stability returned. But here's where the irony creeps in. For the world to grow, it needed dollars, lots of them. Countries needed dollars to trade, to settle payments, to build reserves. How do foreign countries get dollars? By selling goods to the United States, or by borrowing. That meant the U.S. had to run trade deficits. It had to send dollars out into the world. Over time, more and more dollars accumulated overseas. Eventually, there were more dollars circulating globally than the United States had gold to back them. That tension had a name, the Triffin dilemma. The country issuing the world's reserve currency must supply liquidity to the world, but in doing so, it weakens its own foundation. By the late 1960s, the math stopped working. In 1971, President Richard Nixon ended the dollar's convertibility into gold. The gold window closed. On paper, this should have been the end of dollar dominance. The anchor was gone. The currency was now backed by what exactly? And yet the dollar didn't collapse. It expanded because something else had quietly taken gold's place. U.S. Treasury bonds. Here's the key shift. The dollar stopped being a promise to exchange for gold. It became a claim on the U.S. government. And the U.S. government offered something the world desperately needed, an enormous supply of safe, liquid assets. Imagine you are a central bank in Asia. Your country exports more than it imports. You accumulate dollars. You don't want those dollars sitting idle. You want to invest them somewhere safe, somewhere you can sell instantly if needed. U.S. Treasuries became that place. They are large in scale, trillions of dollars outstanding. They trade in deep, liquid markets. They're backed by the taxing power of the world's largest economy. Over time, the dollar became less about gold and more about financial depth. Today, around 60% of global foreign exchange reserves are held in dollars. Nearly 90% of foreign exchange transactions involve the dollar on one side. A majority of global trade is invoiced in dollars, even when the United States isn't directly involved. A company in Brazil selling soybeans to China? Often priced in dollars. Oil from the Middle East? Priced in dollars. International loans? Frequently denominated in dollars. Why? Because when two countries trade, neither wants to bear the risk of the other's currency swinging wildly. So they default to a third option, a neutral ground. The dollar became that neutral ground. And once that habit formed, it reinforced itself. If everyone else uses dollars, you use dollars too. That's the network effect. But here's where things get more complex. There isn't just one dollar system. There are two. The domestic dollar system, managed by the Federal Reserve, and the offshore dollar system, often called the Eurodollar market, where banks outside the U.S. create dollar-denominated deposits and loans. That's exactly why the U.S. dollar dominates the world economy. If you want more videos like this, where we break down complex finance and global money systems in a clear, simple way, make sure you subscribe to the channel.